You ever look at the market and just see chaos? How do professional traders find a clear path through all that noise? Well, it's not some crazy, complex system they're using. Today, we're going to pull back the curtain on a strategy that is an absolute staple on pro trading desks, and it's all about its simplicity and raw power. We are decoding the 9 EMA Continuation trade.
And that quote from Jeff Holden over at SMB Capital? Man, it just hits the nail on the head. This is not about cluttering your charts with a dozen different indicators. No. It's about deeply, truly understanding one single tool that shows you the market's pulse in real time.
And that really is the big question, isn't it? The secret isn't some magic formula. It's about mastering one tool that's perfectly tuned to the rhythm of the market's biggest players. It lets you anticipate their next move instead of just reacting to all the random noise out there.
Okay, but before we jump into the how-to, it's absolutely crucial to understand the why. You can't really trust a signal if you don't get what's making it tick and who's behind it. So let's build that foundation right now.
So first up, we have the old school standard, the simple moving average, or SMA. You know that 200-day moving average they're always talking about on the news? That's it. It gives day 1 and day 200 the exact same weight. It's slow by design, kind of like trying to judge a quarterback by averaging every single throw he's made all season. It gives you the big picture, sure, but it's always looking in the rearview mirror.
Now contrast that with the Exponential Moving Average, the EMA. It is a completely different animal. While it also looks at a set period of time, it puts way more importance on what is happening right now. Think of it like a memory that fades, which makes it incredibly quick to respond to the latest shifts in the market.
And this analogy just illustrates the difference perfectly. If the SMA is a giant aircraft carrier, slow, deliberate, telling you the overall climate, the EMA is like a destroyer. It's still a massive, stable ship, don't get me wrong, but it turns the second you move the wheel. It shows you how the climate is changing in real time.
So here's the key. This is the magic. When we shrink that time period way down to just 9, the 9 EMA basically becomes our weather radar. It stops measuring the long-term climate and starts tracking the wind direction this very second. And you know what else operates on that frequency? The big institutional algorithms that have massive orders to fill and have no choice but to act on what's happening right now.
Now, here's what's really interesting. You can give the exact same tool to 2 different pros, and they'll each develop their own unique edge from it. Let's take a look at 2 traders from the SMB Capital desk, Jeff and Enrique. They both use the 9 EMA, but in slightly different and equally effective ways.
All right, let's break down these 2 styles. You've got Jeff, who's on the fast 1-minute chart. He trades what he calls the reclaim. He's not afraid of a little bit of noise. In fact, he waits for the price to actually dip below the 9 EMA. He's looking for that exact moment when buyers aggressively jump back in to take back that level. For him, that little dip is valuable information. Then you have Enrique. He's a bit more patient, trading the bounce on the 2 or 5-minute chart. He wants to see the price come down, touch the 9 EMA cleanly, and bounce right off, proving that the buyers are still 100% in charge. So you see the trade-off, right? Enrique's style is higher probability because he waits for that clean confirmation. But Jeff's aggressive entry, it often gives him a way better risk to reward on the trade.
So, we've got the theory, and we've seen how the pros do it, but how do we turn all this into something you can actually use? Let's build out a real, actionable playbook, not just for getting in, but just as important for getting out.
It all boils down to a pretty simple 3-step process. First up, context. The stock has to already be in a strong uptrend. We're looking for a stock that's breaking a key level like its pre-market high. Second, the trigger. This is where patience comes in. You wait for it to pull back to that 9 EMA. This isn't your entry. You're just watching to see what happens. And third, execution. You only pull the trigger when you see the buyers step back in with force, confirming that the trend is ready to take off again.
Okay, so you nailed the entry. You're in the trade. Awesome. But listen, great entries are only half the battle. The best traders know that managing the trade is everything. So now what? What are the rules for getting out? A good system has a clear plan for every single outcome.
Here are your 3 clear exit plans. Number 1, the stop out. This is your safety net, non-negotiable. If the trade immediately turns against you and breaks the low of that candle you entered on, you get out, period. The idea was just wrong. Number 2, the profit take. If you get that dream scenario where the stock just explodes away from the 9 EMA, that's your cue to take some chips off the table. Sell a piece, lock in that profit, and finally, number 3, the trail. For whatever you have left, you let that winner run. You just ride the trend, and you only get out completely when a candle finally closes below the 9 EMA.
And really, when you boil it all down, the lesson here is so much bigger than just one indicator. In trading, clarity beats complexity every single time. It's so tempting, especially when you're starting out, to want 10 different signals to line up perfectly. But the pros? They don't do that. They master one signal that they can trust, implicitly.
And that leaves us with this final, crucial idea. The real edge isn't about finding some secret indicator nobody else has. It's about finding one simple, powerful tool, understanding it so deeply that it becomes second nature, and then having the discipline to actually trust what it's telling you, day in and day out. That's the line between the pros and everyone else.